Most people think investing is difficult because markets are unpredictable. But markets have always been unpredictable. What actually makes investing difficult is something much closer to home. It's you. Not because you're careless, not because you lack intelligence, not because you don't want to succeed, but because investing repeatedly places you in situations where your emotions are strongest exactly when your decisions matter most. And the uncomfortable truth is this: most investors don't lose money because they chose bad investments. They lose money because they made reasonable decisions at emotionally wrong moments. In this video, I want to explain why emotional control matters more than returns, why even intelligent investors consistently sabotage themselves under stress, and how the best long-term investors quietly design systems that make emotional mistakes almost impossible. If you've watched my previous videos, you already know this channel isn't about hype, shortcuts, or predictions. It's not about finding the next opportunity. It's not about reacting faster than everyone else. And it's definitely not about outsmarting the market. This channel exists for people who want to understand how wealth is actually built, slowly, patiently, and over decades. If you're looking for excitement, this won't be the right place. But if you want clarity, stability, and a framework that works even when markets are uncomfortable, then this video will matter to you. By the end of this video, you'll understand why emotional control isn't about discipline or willpower, why most investing advice quietly fails in real life, and how long-term investors structure their decisions so emotions never get the final say. Most investors, even experienced ones, operate under an assumption they rarely question. They believe that if they stay informed, stay rational, and make smart decisions, things will work out. This assumption feels responsible, it feels mature, and it's exactly why so many smart, hardworking people struggle with investing. Because it quietly assumes that your decision-making ability is stable across all conditions. But it isn't. You do not make decisions the same way when markets are calm as you do when they're volatile. You do not process risk the same way when your account is growing as when it's shrinking. And you do not evaluate long-term consequences accurately when fear is present. This isn't a personal flaw. It's human biology, and investing is one of the few activities where that biology is constantly exposed. Behavioral finance exists because traditional finance failed to explain how people actually behave. Classical models assumed rational decision-making. Real markets showed something very different. Loss aversion causes losses to feel roughly twice as painful as gains feel rewarding. Recency bias makes recent events feel more important than long-term evidence. Action bias convinces people that doing something feels safer than doing nothing even when it isn't. These instincts evolved to help humans survive immediate threats. They were never designed for long-term, probabilistic environments like investing. Markets don't reward emotional responsiveness. They punish it. This is why emotional control is not about being calm or confident. It's about recognizing that your instincts are misaligned with long-term success. If your investing plan requires you to repeatedly override those instincts under stress, it's fragile by design. Let's make this real. Scenario 1. A mild correction. Markets fall 10 to 15%. Headlines turn cautious. You feel uneasy, but still optimistic. Scenario 2. A prolonged downturn. Markets drift lower for months. Optimism fades, confidence erodes. You begin questioning your strategy. Scenario 3. A crisis. Markets drop sharply. News becomes extreme. Experts debate whether this time is different. In all three scenarios, the investments didn't change. Only your emotional environment did. And that's where most investing plans quietly fail. Not because they were wrong, but because they demanded emotional strength precisely when emotions were weakest. When stress increases, the brain prioritizes short-term survival over long-term planning. The parts of the brain responsible for patience and delayed gratification become less active. Emotional responses take over. This is why investors often say, "I knew better," after the fact. They did know better, just not in the moment when stress narrowed their thinking. Any investing strategy that assumes consistent reasoning during stress is asking for failure. Warren Buffett is often misunderstood. People focus on his stock picks and ignore his temperament. Buffett never claimed to predict markets. He never tried to avoid downturns. He never optimized for excitement. His greatest advantage was emotional durability. Most of Buffett's wealth was built after the age of 60, not because he suddenly became smarter, but because he stayed invested long enough for compounding to work. He made fewer decisions than most investors. And he stuck to those decisions longer. That combination mattered more than brilliance. Buffett didn't win because he reacted better. He won because he didn't need to react at all. Here's the realization that changes how you see investing. Emotional control is not about discipline or confidence. It's about removing yourself from moments where emotion would otherwise decide. Long-term investors don't trust themselves to behave well under stress. They assume fear, doubt, and overconfidence will appear. So they design systems where those emotions don't get a vote. Once you understand this, investing stops being a daily test of willpower and becomes a process problem. And process problems are solvable. Willpower is finite, stress consumes it, systems don't rely on motivation. They rely on defaults. Long-term investors don't ask, will I be strong enough? They ask, what happens if I'm not? Consider two investors. They invest the same amount, in the same market, over the same time period. Investor A stays invested through volatility. Investor B exits during downturns and re-enters later. Investor B often feels smart in the moment. But over decades, Investor A ends up dramatically ahead, not because of intelligence, but because of behavior. This pattern has been documented repeatedly. The market rewards participation. Investors punish themselves through timing. Many investors don't panic completely. They hesitate, they delay, they partially exit. These decisions feel reasonable but still interrupt compounding. The market doesn't punish being wrong once. It punishes repeated interference. The cost of emotional investing isn't just lower returns. It's lost decades. Every emotionally driven exit resets compounding. Every panicked decision delays progress. Most investors don't fail dramatically. They fail quietly by interrupting the process again and again. And the most painful part is that they often realize this only in hindsight. What's most interesting about John Bogle, Charlie Munger, and Peter Lynch isn't how different their styles were. It's how similar their conclusions became over time. Bogle didn't believe investors could outsmart the market, so he built systems that removed decisions wherever possible. Munger emphasized temperament over intellect, warning that emotional instability destroys otherwise sound judgment. Lynch, despite being an active manager, warned that far more money was lost preparing for corrections than in corrections themselves. Different careers, different tools, same behavioral conclusion, none of them optimized for activity. They optimized for not interfering. That convergence matters. These investors didn't copy each other. They arrived at the same conclusions independently. When different paths lead to the same insight, it's usually because something fundamental is being revealed. At this point, the question isn't whether this logic makes sense. The question is where you struggle. Is it staying invested during downturns? Is it resisting the urge to act when nothing feels urgent? Or is it sticking with a plan once it stops feeling productive? Most investors already know the right long-term behavior. The harder part is tolerating the discomfort of not acting. Be honest not about what you believe, but about how you've behaved before. That gap explains more outcomes than any strategy ever will. A real long-term investing system isn't complicated, but it is specific. It includes automatic investing tied to income, not market conditions. Clear rules about when changes are allowed, often years apart, a default response to volatility, do nothing, and long review cycles instead of constant monitoring. Each rule exists for a reason. Automatic investing removes timing decisions. Long review cycles prevent emotional interference. The do nothing default protects compounding. Remove any one of these, and the system becomes fragile. The goal isn't to maximize returns. It's to minimize mistakes. That's how long-term success actually happens. Complex systems invite interpretation. Interpretation invites emotion. Simplicity protects consistency. The fewer decisions required, the fewer mistakes possible. If this way of thinking resonates with you, this channel is probably for you. I don't focus on predictions, trends, or excitement. I focus on long-term behavior, systems, and decision-making. This channel is for people willing to be patient and disciplined enough to remove themselves from their own worst impulses. If that's who you're trying to become, you can subscribe. Quick disclaimer: this video is for educational purposes only. I'm not providing financial advice or telling you what to buy or sell. All investing involves risk, including the loss of principal. Always consider your personal situation and consult a qualified professional if needed. The goal here isn't instruction, it's clarity. At the beginning of this video, I said emotional control matters more than returns. Now you understand why. Returns don't matter if behavior prevents compounding from working. Knowledge doesn't help if emotion overrides it. And the most successful investors didn't eliminate emotion, they designed systems that made emotion irrelevant. Once you see investing this way, it stops feeling chaotic. It becomes predictable not in returns, but in process. In the next video, we'll go deeper into what emotional control looks like during real market stress. Not theory, not motivation, but how long-term investors stay calm when markets fall, headlines turn negative, and fear feels justified. Because early on, emotional control matters more than performance. If you can master that skill, investing becomes dramatically easier over time. I'll see you in the next one.